Hello and welcome to Week 3, Disallowed Losses. By the end of this lesson, you should be able to identify various non-deductible expenses and losses, but also identify miscellaneous allowable losses and deductions. So we're going to focus the first part of the lecture on non-deductible expenses. As the objective stated, we're going to talk about a few oddball expenses and losses that are deductible as well. But first, we'll talk about non-deductible expenses. There are a few expenditures that are considered non-deductible for public policy reasons. Those include bribes, fines and penalties, political contributions, lobbying expenses, and executive compensation. So we as a society have decided that we're not going to financially incentivize paying of bribes, making political contributions, and excessive compensation, among other things. A new entry on the non-deductible list is entertainment expenses, and that's thanks to the Tax Cuts and Jobs Act of 2017. So beginning in 2018, entertainment expenses are no longer deductible, not even for business purposes. Businesses are still allowed business meal expenses at 50%, so not 100% deduction, but 50% of that cost. But there is the same caveat that business meal needs to be an ordinary and necessary business expense, which means it's subject to interpretation by an IRS auditor. Next, we'll talk about hobby losses. We will talk about hobby activities in more detail in a coming week. But for now, we'll just talk about the factors that the IRS considers when they're trying to determine whether an activity is for-profit or actually a hobby. Some of those factors include the activity management, the time and effort spent. So is this a full-time or a regular activity, or is this just something that is done for fun when you have spare time? The expertise of the taxpayer in that activity, as well as the advisors, and if there are any other advisors involved. Success in similar activities is considered. Definitely the activity's profit and loss history, and when there is profits, the amount of those occasional profits. So it can't be huge losses followed by $100 worth of profit for a couple of years, or at least that is not a favorable fact pattern. Expectation that business assets will increase in value is a factor. The financial status of the taxpayer. So is this something that the taxpayer is doing really with the intent of supporting him or herself? Or are there other resources that can be relied upon? And then to a certain degree, the degree of personal pleasure or recreation that is involved. So there's no science, there's no formula. A lot of this depends on how the case is presented by the taxpayer and really the judgment of the auditor. So again, we'll talk about hobby losses in more detail in a coming week, but just be aware that for clients who are doing things that are generating a little bit of income and a lot of expenses, you need to be aware of these hobby loss rules and make your clients aware of them as well. We'll talk a little bit about rental properties. Again, in a future week, we'll talk a lot more about rental properties. But if you are renting a vacation home, so a home that you're using more than 15 days a year, or if you are if you're using for more than 10% of the rental days, then there are some special rules that are used to figure out how to allocate expenses. And actually, although the slide says rental of vacation homes, I have a few clients here in Tucson who rent their personal residences through Airbnb or a similar service. And so they are considered a mixed-use rental. It's not a vacation home, but it's a home that they're obviously occupying for more than 15 days and more than 10% of the rental days. And so when we figure out their rental activity, we definitely have to report all of the income that they've received, but the expenses must be allocated based on the ratio of the number of rental days to the total number of days occupied. Now that deduction is above the line. Rental activities are reported on Schedule E, and then the total on Schedule E flows to an above the line number on the page 1 of the 1040. But note that current year losses may be limited, the loss deductions. This is true for any type of rental. And again, in a future week, we will talk in more detail about those limitations. A primarily rental use property, so a rental property that the taxpayer is not occupying at all or under 14 days per year. We still have to report all the income, but all of the expenses are deductible. And there are expenses that are deductible for rental purposes that you wouldn't necessarily get to deduct if this were a personal residence, like homeowners association dues or repairs and maintenance, even utilities if the tenant is not paying those. Again, deductions are above the line, and again, current year deductible losses may be limited depending on the total tax circumstance of the client in a given year. Next, we'll talk about bad debts. There are two types of bad debts: business bad debts and non-business bad debts. Something that is difficult for my business clients to understand is the concept that only accrual basis taxpayers are allowed to take business bad debts. So as we've talked about in previous weeks, 99% of individuals are cash basis, and most small businesses, even a lot of medium-sized businesses, are now eligible to use the cash basis of accounting. So by far, a majority of my clients are cash basis. And so if I have a client who has provided products or services for a client, they are keeping a list of people who have not paid them. That's called accounts receivable. And so they know if they have to write off an accounts receivable, and to them that's very real. They either provided a product, gave them something tangible that they did not get paid for, or they provided a service. So in the case of a financial planner or a tax preparer, I prepared a tax return, I issued a bill, I filed the tax return before I received payment, and now the taxpayer is not going to pay me, so I gave away my time. But for all of my clients and myself as a cash basis taxpayer, I do not include in my gross income those amounts billed as revenue. So as a cash basis taxpayer, I am only including amounts received. And if I have not included the amount billed in my revenue, then I cannot take that offsetting deduction. So that's a long-winded way of saying that it's only when clients have included that bill in taxable income that when they have that bad debt, when they do decide to write it off, that they are taking that offsetting deduction. Non-business bad debts work a little differently. A business bad debt can be partially worthless, and whether it's partially or fully worthless, the write-off is taxed at ordinary rates. But a non-business bad debt must be totally worthless. It cannot be partially worthless to be written off. And a non-business bad debt is always considered a short-term capital loss. Similar to non-business bad debts, the IRS code provides special treatment for small business stock, losses, and worthless securities. So any type of security that becomes worthless, no matter how big or small, is given capital loss treatment. The key is trying to figure out when a security becomes worthless. So again, it must be completely worthless. You probably have clients who come in to you and they have Frontier Communications or some of those little spin-off stocks that are worth almost nothing, but they do still show pennies per share because they are traded somewhere. Unfortunately, that is not a worthless security. It must be 100% completely worthless, which means the company ceases to exist or goes bankrupt to have that capital loss treatment. Now, often clients will invest in not a publicly traded company, but a smaller private company, typically a friend or a neighbor or something like that. And everything's going great for a while. There's losses that are being generated, but that's normal and everything's going to be great. And then all of a sudden they hear nothing from the people who were giving them regular updates. They no longer get any kind of information. They don't get tax documents. And the client will say to me, can I write this off as a worthless security? So the first step I ask them to do is to see if you can contact that person that you used to be corresponding with on a regular basis and have them give you something that says this corporation is no longer in business, this corporation has declared bankruptcy or something like that. Typically, the client will attempt to do that and will receive no response. In that case, if it's a small amount, we may just go ahead and take that capital loss. But if it's significant at all, then I would advise the client to write a letter to that last contact person saying, "Dear to whom it may concern, I hereby relinquish all rights to this security as of this date." And that way, if the client were audited, we would have proof that yes, the entity may be out there, but we no longer have any rights to any tax attributes, any capital, anything from that investment. So any security can become worthless. Those smaller companies can benefit from Section 1244 treatment, which allows a small company loss to be treated as ordinary income up to $100,000 per year. This is for a C corporation stock, so this is not actually all that common. A lot of Silicon Valley stocks, they start out, entities I guess I should say, they start out as LLCs, they later become C corporations for other reasons, but more small businesses are organized as something other than C corporations, so I don't see this a lot, but it is a provision in the tax law, and we will talk more about what a C corporation is versus an S corporation and an LLC in a future week. Personal losses are not deductible. You buy a car, you use it personally for a few years, no business use. Eventually you go on to sell it. Let's say you don't trade it in. Obviously you're selling it for less than you paid for it. That's a personal loss. Likewise, if you sell a personal residence, we talked in a previous lecture about the tax benefits of capital gains not being recognized on a sale of a personal residence. Unfortunately, that also means that a loss on the sale of a personal residence is not deductible. Now, taxpayers have tried little tricks to get around not being able to deduct those personal losses. Taxpayers have tried converting a personal residence to a rental. The IRS has recognized this, so there are rules around how long the entity, the property, must be a rental in order to get that full deduction treatment. Next, we'll talk about net operating losses. Net operating losses are a business concept. So you may say, well, this is an individual income tax class. I deal with individuals. So how does the net operating loss really affect me and my clients? Well, your individual client could be a sole proprietor, could be a partner in a partnership, could be an S corporation shareholder, and all of those items of income or losses flow through to your individual taxpayer's tax return. Therefore, business losses reported on that Form 1040 could possibly generate a personal NOL. NOLs, whether it's on the business corporate tax return or on the individual's tax return, can be carried forward or carried back. The NOL is an above-the-line deduction, so it's one of those more valuable deductions reducing AGI. And it's also important to note that the NOL must be carried back unless an election is made. So you want to make sure that your client has a good tax preparer who is alert to this. And if, for instance, the past couple of years were low income tax years anyway, and you wouldn't get as much, the client wouldn't get as much tax refund as if the loss were carried forward, then you want to make sure that election is made, and it has to be made on a timely return, which is why you want to make sure your client's working with a good and knowledgeable CPA if they're in this situation. Another type of business deduction is depreciation. We will spend half of 1 week talking about depreciation, but right now it's just important to know that when a business buys assets that are used in that trade or business and they last more than 1 year, typically you can't just write off $10,000, $20,000 of equipment. You actually have to write it off over a prescribed number of years. There are ways around that. There are exceptions, which we'll talk about in a future week, but just know that depreciation is something that your business clients will need to deal with. If you have taken the retirement planning class, or if you're in practice, you certainly are aware that there are limits to the amount of retirement plan contributions that a person can make. And in order to enforce those limits, if someone makes an excess contribution, there's a penalty. You also, I'm sure, are aware that there are requirements or restrictions on when a taxpayer can take money out of a retirement plan, and there's a penalty if there's an early distribution. And then finally, there's also penalties for late distribution. So everybody eventually has to take money out of their retirement plans, and if a taxpayer doesn't want to, forgets to, deliberately doesn't take the distribution, there's a pretty significant penalty if they don't take the distributions that are required of them. So in summary, in this lesson, we've learned about certain expenditures that are disallowed for public policy reasons, and we've also talked about some additional deductible and non-deductible expenses.